And welcome back, everyone. Today on the show, we're going to run through some common questions we get about charitable giving. By the time this airs, there should still be some time to squeeze in a little bit of tax planning by the end of the year, but are you doing it optimally? Stay tuned. So welcome back to the MedTech Wealth Advisor Show. Remember, this is the show dedicated to helping professionals in the MedTech industry make smarter decisions with their money. We discuss a wide range of personal finance topics like retirement planning, equity comp, investments, and all with the goal to help you save more money, pay less in taxes, and align your capital with your values. I'm your host, Matt Nelson, Senior Advisor here at the Perspective 6 Group at Focus Financial. If you want to learn more about our firm, check out our website at perspective6group.com. And today, as always, I've got our resident financial planner, Jacob LaRue, with me to discuss this topic. Welcome back, Jacob.
Oh, yeah. This is going to be a good one. Thanks for having me again.
Yes. What's new from the LaRue household?
Yeah, we got a busy week ahead of us, I think. We got our little girl's first birthday coming up this weekend. So going to have a bunch of people over here and have to entertain them. Hopefully everything runs smoothly. And I can't believe it's been a year, but it has. So time flies. You know,
as someone without kids, all that sounds like to me is another way that your kids are costing you money. So like you gotta host a party. You gotta bring everybody over.
We're on the plate for food and everything. So
yeah, it'll be fun. That'll be fantastic.
Just add it to the bill that goes on for 18, 20 years, whatever it is.
Yes. I can live vicariously.
Yeah. What about you? What do you got going on?
It's not this coming weekend. Actually, as we're airing this in 2 weeks, I've got a race coming up called the Schwammegan Fat Tire. By the time this airs, this will be over, so we can hear about the results at that point. But that's what I'm preparing for today. It's a mountain bike race. If you're in the Midwest, you know about it. It's kind of the big deal end of year mountain bike endurance race. It'll take about, somewhere like 2.5 hours. If I can come in 2:45, I'll be happy, something like that. So we'll see. I'm getting older, getting slower. I just got to keep up with the young guys is all.
How many years have you been doing that one?
Oh man, 20 years, something like that.
Nice.
A lot. Nice. That ages me. It's fun though. Maybe it actually keeps me young. I don't know. Well, yes. So we'll check in on what happened with the birthday later. But today, let's get to our topic. Charitable giving. So again, this should air before the end of the year, sometime in November, I think. And you'll have a little bit of time to do some giving, and people bring this up all the time, and they want to know what's the best way to do some tax saving. Is there anything I can do to lower my tax bill? And so, when we talk about charitable giving, there's a lot to it. Today, I think we're just going to talk about really, let's just say 3 big points. So think about why you're giving in the first place. We'll talk about that. Then the actual tax considerations, and then some of the initial methods that you could use, more of the baseline methods, we'll call it. I think maybe in a future show, we'll talk about a little bit more advanced giving strategies. But I always start this conversation out with, it's not about the taxes first. This is giving to causes you care about should be the number one priority. It's great. It's great to want to save on taxes, but it makes no sense to give $1 to charity just so you can save 40 pennies if that was the only thing you wanted.
Exactly. Yeah, I can't believe how many times we have to kind of reiterate that with clients. It's just, you got to make sure your values are lining up with what you want to do with your money first. So it's not about the tax savings, even though that's what's on most people's mind. You got to really care about the cause that you're going to be contributing to.
Yeah. I mean, that said, there are plenty of ways to combine the two goals of giving and some tax savings, and doing it in the proper order, in the proper year, and all of that can make it the most beneficial. But just prioritize the desire to give over saving. And that's That's the first baseline item. Now, actual tax considerations. So there's a handful of things to consider here. You've got deductions and how those work on the tax return. So we have to understand how that works first to actually make charitable giving even work for you. It got a little bit trickier in the last few years once the standard deduction and the itemized deductions changed. So let's talk about that first, because I guess the thing I picture is when a client will come in with a box of receipts, or they'll tell me that they've been saving their receipts all year, and they give them to their accountant, and they figure their accountant's taking care of it. And then we look at their tax return and they've taken the standard deduction. So why don't you explain what happens there, Jacob?
Yeah, that's a perfect place to start. Comes to my mind is somebody who tells us, hey, I gave $10,000 to charity last year and I got a deduction for that. I'm going to keep doing it. Well, you might think you get a deduction, but like Matt said, 4 or 5 years ago now, we're already in 2024. So this is getting old quick, but standard deduction pretty much doubled compared to what it was prior. So remember how that works. Your standard deduction is something you get no matter what charitable outcome or giving you do. So everybody gets a standard deduction, and for 2024, it's almost $29,000 for a married couple. So that's a big number. So you get that right off the bat.
When did that actually shocks me. I can't quite keep up with them. That's why I was have to rely on you to remind me. 29,000. That's just, how much was it last year?
It was about 27, 28. Yeah. And it just keeps going up because, they adjusted for inflation and things like that. But, if we go back 5, 6 years, that number was in half. It was only about 12,000 back then. So this is why charitable giving is really hard to narrow down what you're getting a benefit for, because if you gave 10,000, well, you may not even itemize, because that's not going to necessarily put you over that 29,000 when you combine it with everything else. So just know that you already are getting a pretty big deduction, whether you're giving to charity or not. So now there's got to be some things that we got to be aware of when we're thinking about charity.
Right. Yeah. So basically what you're saying is, if we don't do bunching, or, grouping our giving, maybe giving ahead, might not even give that big of a benefit. But that brings us to the other consideration, which is some limitations, because now with that standard up at almost 30,000, you have to do such a significant gift again to get any benefit. We got to start being aware of the limitations. So explain how that works. The function of the maximum giving you can do, and what's going on there.
Yeah, exactly. So charitable giving, when we're talking about deduction purposes and the caps that are tied, they're all tied back to your income. And specifically, that's your adjusted gross income, or AGI, as some people might refer to it. So a really easy example for most people out there, if you had 100,000 as your AGI on your tax return, your cash gifts could be about 50% of that. So you could give 50,000 of cash and actually get a benefit on your tax return that year. But if you give 55,000 or 51,000, anything over that number of 50, that doesn't get counted for that tax year. It does get carried forward to the next tax year, but just know there is caps tied to your income on an annual basis. So there's that cash cap that I just talked about. And then another big one for clients, especially in the equity comp space, might be, capital gain assets like stocks or bonds, etc. This cap is only 30% of your AGI. So you might give 100,000 of stock that's appreciated, and if your AGI is only 100,000, you're actually only going to get a benefit for that 30,000. So you just got to be aware of these caps and make sure you're doing careful tax planning on a year-to-year basis.
Right. Yeah, absolutely. When we have some of the advanced strategies with maybe pairing a really big equity comp year bunch of RSUs come due, bunch of income is in that year, and we're trying to reduce the income. Well, now we already have a huge income year, so it's a lot easier to sort of like marry these two together. But I think of maybe our retired clients who we're trying to purposely keep their income, their taxable income really low. And then they go and do a gift, and we just have to be careful what's happening there.
Exactly. Yep. There's moving parts anytime you're dealing with charity or stocks in general. So you just got to look at it year to year basis.
Okay. Well, let's cover some of the basic methods, or the maybe the well-known methods first, and then a little more unique one that only matters for certain ages. So, you've got your typical giving personal stuff. We'll start with the easiest one. That's the classic donating to, in our town, we give to ARC, or you have Salvation Army, or any number of places you can give a bunch of old clothes or, furniture or whatever it is. So that works great. Just make sure you get your proof of receipt. Think about the limitations. That's the first method. Okay. Not a lot of restriction there, not a lot that matters to our audience in this one, but then giving cash. So we talked about the limitations with giving cash, and certainly just giving, the classic write a check, send it directly to the charity. That's all great. Got to keep the receipt. There's probably better methods to gift the cash than just writing a check, and we'll talk about that a little later. But then the more complex would be giving a low basis stock. So you alluded to that in the limitations above, but walk us through an example of how you might give some stocks you own and why that might be better than just giving straight cash.
Right, exactly. So think about this. Let's say you bought Apple in 2000 and you had 100 shares of Apple, and you held it all the way to now. Those 100 shares are going to be worth a lot of money, and you might not want to pay the tax on those. So you can actually gift those to a charity, and some charities have a way that you can just transfer the stock directly to them, which is awesome. So now you're removing that capital asset off your balance sheet. And what's really nice there is you get potentially a tax deduction, and you're avoiding the capital gains on that stock. So if Apple was $1 when you bought it and it grew to 100, you're going to avoid $99 of capital gains times how many shares. So that's a really good strategy.
Super good method. Yeah. And in fact, I'll jump in there with plenty of times we want to continue to hold Apple. You might not want to actually sell your Apple, but you've got this choice of, hey, I actually do want to give this. Let's just say it's a larger gift. Let's say I want to give this $50,000 to, your organization's capital campaign. Okay. So it's a larger gift all in one year. And you could do it out of cash. Maybe you got some money sitting in a money market or savings account or whatever. Or you could give some Apple stock. Well, if you don't want to sell the Apple stock, think of it as just an exchange. So if you do it correctly, you actually give them the stock, avoid all of the capital gains on it, get the same deduction plus that bonus of not having to pay the capital gains, and then take your cash and just rebuy Apple stock. And it's completely fine. It's not a loophole. It's just a strategy. You don't have a wash sale or anything complicated that happens.
Yeah, it's a perfect example. It's like the ideal scenario where you get to keep the stock because you're buying it with your own cash, and you're giving to hopefully a charity that you care about. So really good strategy. There's other things that we'll talk about here too. Donor advised fund is very popular. We'll hit that in the next show, but it's a really good strategy. You can think of that as like a charitable account that's in your name. So just keep that in mind when we go forward here.
It's really like supercharging the strategy with giving your stock. Yeah, that's why we need to spend some time on that.
Exactly.
But before we move on off of the low basis stock, let's just quick touch on, a lot of listeners have equity comp because that's kind of the market we serve. And so we're running into people that have restricted stock, that have restricted stock units and awards. They're getting stock options. let's talk real briefly about if that's something that can be given to charity and it doesn't work.
Right. Yeah. So biggest thing there is the vesting schedules. So more often than not, if the stock's not vested, they're not going to just let you transfer it to a charity. But as soon as it's vested and now you hold it, you have some choices to make, whether it's, use it for your cash flow, holding it long enough so there is actual a charitable benefit. Those are all things to consider. But just remember, the vesting on any type of equity comp there is going to be the most important trigger when we decide what to do with it.
Right. And it's although there can be some strategies that are maybe more complex and get some additional benefit with giving your equity awards, or we'll just say your equity compensation. A lot of times it's kind of more simple. If you're getting RSUs and you can't give them till they're vested anyway, well, then what's really happening? They've vested, you're claiming that as income. And now you have shares. And now if you give the shares, if there's no appreciation, that really wasn't any benefit at all. It just was kind of like giving cash. If it was a set of RSUs that you received, paid the income, and you've been holding that same stock now for 2, 3, 4, 5 years, and there's a bunch of appreciation, great, you can gift those shares. At that point, though, it's not any different than just had you bought stock on your own and held it for a while. So don't complicate it too much in your mind that certain kinds of equity compensation practically become similar to just owning regular stock and giving it.
Yeah. I think a good way to maybe say it is don't hold on to your RSUs just to give them later.
Yes. It's a great.
Don't overcomplicate it, like you said. So
perfect piece of advice. Exactly. Later we could talk about, some specifics. If let's say you're early stage, maybe private company, you actually had some true restricted stock. Now, I'm not talking about RSUs. I'm talking about stock that has some legends on it. It's got some restrictions from you being allowed to sell. If you have it, you have it because it's subject to Rule 144. But sometimes gifting those shares, because they're extremely low basis, can be really advantageous, especially if you pair it with maybe the company's gone public and you've got a bunch of RSUs that have come due and you have a huge income year. So there are times when we could pair charitable giving with tax strategy and equity comp, and it makes a lot of sense.
Yeah. It's a cash flow timing that we've talked about several times now, but you got to line things up
really
with charitable giving, just like we do with cash flow. So,
well, with the time we have left, I want to touch on this significant method, which we use all the time, called QCD, or Qualified Charitable Donation. Okay. This is probably it's potentially one of the most underutilized methods, although it's gaining popularity. Now it's been around a few years. When we first started using it, almost no one had heard of it. Accountants thought we were crazy. That I was asked what was going on. Now, of course, more and more people know about it. But just to go through it, where what we've talked about so far was giving things that let's say you personally own, or cash, or low basis stock. This is giving from an IRA. So it's a whole different method. The key, though, is you have to be old enough to make this work. So talk about how we use this in our strategies.
Yeah, this is a big deal for anyone really that's taking required minimum distributions, RMDs. I'm sure a lot of our listeners that are retired are like, oh, I have RMDs. Well, RMDs fully taxable. So if you had 10,000 of an RMD this year and you distributed it to your bank account and then you gave it to charity, you're still paying tax on $10,000. The QCD is great because what you can do is take that 10,000 from your IRA, send it directly to a charity, and it's pretty much like it never shows up on your tax return. You don't claim it as income. It doesn't get taxed. You don't have to itemize your deductions to get a benefit for the charitable gift. It's all just dollar for dollar reduction. It's perfect for anyone with RMDs.
Yes, that's the big key, and then why we touched on the limitations with the standard versus itemized first is that this is the key. If you, especially for smaller gifts. So if you're over 70 and a half, you have an IRA, and let's just do a classic example of, hey, I give $5,000 a year to my church, or maybe it's more, maybe it's even, well, nowadays, maybe it's 15 or 20, but you're just doing that out of cash. Just like we talked about earlier, you literally get no benefit from that. I mean, other than you gave to your church. So that's a huge benefit, right? Remember, you're giving first because you want to, but you get no tax benefit by doing that. And if you have an IRA, now you can give it, like you said, essentially almost behind the scenes, and you lowered your RMD for the year. So you lowered your income.
Yeah. I think what we like to tell people is like you said, give because you cause or care about the cause, but also got to gift wisely and smart. You don't want to just waste dollars necessarily. So give because you care, and then let us help you with the wise part of it.
Yeah. A couple of things I'll touch on before we wrap up is there is a mentality shift you have to go through when it comes to giving this way. So if you've been going along and used to, let's just say the really old school method of, you write a check every time you go to church, just because let's say that's a weekly thing you do, and you put it in the offering plate, you won't get to do it that way anymore with a QCD. Or, maybe it's you show up to your favorite charity's annual drive and you like to write a check and give it to them right there. Same situation. To do a QCD properly, the money has to come directly from the custodian. So let's just say you have your IRA at Schwab. Okay. Schwab has to be the one to send the check from your IRA direct to the charity. Can't come to you first. Has to be made payable to the charity. And it's easier than it sounds, but you just have to do it in the proper order, kind of a method to it. The other thing to realize, though, is it doesn't happen overnight. So there's a little bit of timing to consider. Let's just use that church example again. If it's a weekly situation, well, if you're going to start giving from your IRA, you may just want to have a conversation with your church's treasurer and say, hey, I know I used to do it this way before, but now what's going to happen is maybe on January 1st or in December, just one big check for the year is going to come from my IRA. Just give them a heads up so they can still plan their budget correctly. Frankly, they don't care the timing. They just need to know when. That's the biggest one. And then, of course, you'll need to work with your financial advisor, work with us to get the check over.
Yeah, that's a great point. And I'll also add to that, some people, if they're given to a church or another organization, there might be special campaigns, like you said. Schwab's really good about writing in memo line items. So, hey, this might be for the capital campaign or the building fund. You can add those things to the check from the IRA. So then it gets directed to the right project that you want it to. So it's a really good source.
Yes. And the last point is be careful. We're not going to make this determination for you. So be careful that you aren't directing a contribution this way to, let's just say your annual charity's dinner event. And actually the dinner is valued at $100 a piece. You brought guests, and then you got a gift, and maybe they provided something else. Maybe it was like an event on a boat. Okay, so you got to be careful that the money is actually going only to charity. If it's really paying for goods and services that you got a lot of use out of, all of a sudden that's not a charitable thing, and it's not something you want to find out later in an audit. So that's all I'll say about that.
Yep. Audits are no good.
Yeah, that's right. So that's pretty good for right there. We could put a pin in it. I think, again, Love to work with clients that are doing charitable giving. Just want to do it the right way. Prioritize giving first. Make sure we're getting the right deductions and think about standard versus itemized, maybe having to group and give more in 1 year or not. And if you're old enough, maybe you're using a charitable donation, a QCD. If you have low basis stock, that's one of the best methods as well, if you're not old enough and have an IRA. So I think that's it. Is there anything else you wanted to add before we wrap up?
No, I don't think so. I think this was a really good episode, and hopefully people had some ideas pop in their head. And yeah, we love to talk about charitable giving and the proper way to do it. So.
Love it. Yeah, I think we'll talk about donor advised funds next. So stay tuned. If you want to listen to that, wait for next week's download and get that. So that's all we have time for today. Look, if you need guidance on this, just let us know. You can contact us at our phone number, 952-225-0333. And check out our website, perspective6group.com. If you know someone who might find this helpful, just send it to them directly. Click the share button, let them know, and give us a review too. I've been seeing some reviews. It's helpful to see what people like and don't like. And if you have suggestions, I'd love to have those. We want to talk about what's important to you. This is really for, clients and really everybody that wants to learn more about financial planning, about investment topics, about equity compensation. We work with mostly med tech professionals, but also a lot of retired clients who've never been in med tech. So broad range of topics. Let us know what you want to hear. So until next time, remember, financial freedom takes more than money. So find your purpose and make a plan to live your life well. If you need guidance, we're here to help. Take care of each other out there.